Today, we're diving into the world of covered call ETFs. If you're an investor looking to generate extra income while diversifying your portfolio, then this video is for you. We'll break down what covered call ETFs are, how they work, and how they can fit into a well-rounded investment strategy. Fasten your seatbelts. This is going to be a good one. So what is a covered call ETF? An ETF, or exchange-traded fund, is a type of investment fund that holds a collection of assets like stocks, bonds, or commodities, and they can be traded on the stock exchange like the TSX. A covered call ETF is a specific type of ETF that employs an option strategy known as covered calls to generate additional income for its investors. Covered calls involve selling or writing call options on stocks that the ETF already owns. A call option is a financial contract that gives the buyer of the option the right, but not the obligation, to purchase the underlying stock at a specific price that we call the strike price within a certain time frame. By writing covered call options, the ETF collects a premium from the option buyer. This premium is then typically distributed to the ETF's investors as additional income. In a moment, we are going to break down just exactly how this works. Join the conversation. Let us know in the comments if you currently have any covered call ETFs in your portfolio. Your participation is well appreciated. Don't forget to like and subscribe to stay up to date on future content, and thank you for that. Click. Okay, let's break down how covered call ETFs work. So the manager of the ETF fund starts by purchasing, that basket of stocks, commodities, bonds, whatever it is that they're going to be putting into that ETF. They then write call options on some, or sometimes in some cases, they may write them on all of these stocks. Usually it's only a certain percentage. Remember, the ETF already owns the stocks, which is why it's covered if the options are exercised. When the call options expire, because remember, there is a specific time frame, there's basically two possible outcomes. First, if the stock's price is below the strike price, the option expires absolutely worthless, and the ETF manager keeps the premium they collected, and of course they keep the stocks too. So that's the best case scenario. They might then write new call options and collect additional premiums. Remember, these premiums are helping to enhance the payments to you guys, the shareholders of that ETF. Second, if the stock's price is above the strike price, the option buyer can choose to exercise the option and buy the stocks from the ETF fund at that strike price. Mind you, in this case, that strike price is probably lower than what the actual share price is at that moment. The ETF then keeps the premium, but it must sell the stock at that agreed upon strike price, potentially missing out on further gains. The ETF manager will buy back the stocks they sold at the new price, so they will have slightly fewer stocks, but the overall market value of the fund will still remain the same. So, how can covered call ETFs fit into your investment portfolio? First and foremost, they can help generate additional income, as the premiums collected from selling call options are typically distributed to investors as dividends. This can be particularly appealing to income-focused investors, such as retirees. Second, covered call ETFs can provide some downside protection. The premiums received can help offset potential losses if the underlying stocks decline in value. However, it's important to note that this protection is, of course, limited. If the stock price drops significantly, the premium income may not be enough to fully offset the loss. Third, covered call ETFs can contribute to portfolio diversification. Since they combine both stocks and option strategies, they can help reduce overall portfolio risk by spreading investments across different asset classes. However, there are some potential downsides to consider. Writing covered calls can limit the upside potential of the underlying stocks, as the ETF may be forced to sell them at the strike price if the options are exercised. Additionally, covered call ETFs may underperform in a strong bull market, as they can miss out on large gains from rapidly appreciating stocks. Now that we've covered the basics, let's look at some examples of popular covered call ETFs available in the market currently. For these examples, I have two Canadian covered call ETFs and one American covered call ETF. You will find that currently covered call ETFs are much more popular in Canada, and the US is just starting to catch on to that trend, so you can look forward to a whole bunch of covered call ETFs popping up on the US market. We will first of all look at the Hamilton Enhanced US Covered Call ETF. They have a ticker of HYLD. This ETF, it invested in American ETFs with the goal of replicating the selective U.S. covered call ETFs index. They have a dividend yield of 14.301%, which is paid out monthly in the amount of 14 cents per share. That, of course, is not too shabby, and you're going to find a lot of these covered call ETFs have pretty high payouts. Now, the interesting thing with HYLD is it is a community favorite. It is one of those covered call ETFs that has depreciated a lot through the share market, but I do have some high hopes on seeing what it does once we start moving into recovery. The next Canadian one that I have is the Horizons Enhanced Income Energy ETF, ticker ENCC. This ETF, it invests in a strong basket of Canadian oil, gas, and energy companies. They have a dividend yield of 14.142%. That is paid out monthly in the amount of 13 cents per share. This is another one that their price will start to recover a little bit once we start seeing a recovery within that oil sector. Okay, and I did say I had one from the US, and it is the Global X NASDAQ 100 Covered Call ETF. They use a ticker of QYLD. This ETF, they track the NASDAQ 100 index, and it has a nice looking dividend yield of 12.362%, which is paid out monthly in the amount of 16.9 cents USD. Now keep in mind, one like this, you want to keep it into your RRSP, because if you throw that into your TFSA, you're going to lose 15% of those dividends, and well, that makes a high dividend yield a little bit less high, if you get my drift. This is one you can definitely keep in your personal account, though you will pay on the capital gains, and you will still be charged that 15% withholding tax on your dividends, but you can get that back at tax time. Covered call ETFs can be a valuable addition to your investment portfolio if you're looking for additional income, some downside protection, and of course, diversification. However, it's crucial to be aware of the potential limitations, such as capped upside potential and underperformance in strong bull markets. As with any investment, it's essential to conduct thorough research and consider your own risk tolerance and investment goals before adding covered call ETFs to your portfolio. You might also want to consult with a financial advisor to ensure that covered call ETFs are a suitable investment for your specific portfolio. Keep the learning going. Watch my video on Sun Life versus Manulife in a deep dive battle. I have that linked on the left, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner. See you in the next video.